Good morning, everybody, and welcome to the latest webinar from thebusinessdesk.com. I'm Alex Turner, and I will be taking you through the next hour as we look at today's topic, surviving or acquiring strategies for business success in uncertain times. As we all know, 2020 has been very hard for many businesses. And while we now have the good news of a vaccine on the horizon, the coming months are still expected to bring a wave of economic challenges. Unemployment is expected to continue to rise. Businesses will be under serious threat as they face challenges of fragile confidence, as well as structural changes in the economy that have been accelerated by the events of this year. All of that will come together to hasten tough decisions for business owners and leaders in the coming months. Businesses might have to restructure, but done properly, they can emerge into the new economy right-sized and refocused. For others, it presents the opportunity to grow by acquisition, as perhaps previously unavailable companies which are now struggling become available. So this morning's webinar, which we're delighted to do in partnership with Quantuma, it's really going to focus on how businesses can be resilient, be right-sized and refocused, and be ready for those opportunities. We've got four great speakers with us this morning. We've got Dr. John Ashcroft, Chris Yates, Frank Offenagaru, and Ian Barton. And I will introduce them in more detail shortly, but they all bring their own perspectives to this topic. The format's nice and straightforward, so I'm going to speak to each of them individually to begin with for a few minutes each, and then we will move for the second half into a panel discussion where we'll bring everyone back. At that point, we will also look to bring in your questions. So I'm sure many of you are familiar with Zoom. So if you scroll to the bottom, there's a Q&A button. If you click that, you can type your question in, and I will put those to the panel, as I said, in the second half of the discussion. So without further ado, I'd like to crack on and introduce our first speaker for the morning, which is Dr. John Ashcroft. John specialises in economics and strategy. Many of you will know him as the Saturday Economist. He's led businesses and is now an advisor and consultant to a range of businesses in a range of industries. John, thanks very much for joining us this morning. As I mentioned, 2020 has been tough for many businesses. Is there an end in sight?
Well, good morning, Alex, and good morning to everybody. Yeah, I think we had a pretty good steer on what was happening this year. So pretty early on, we were forecasting a 20% drop in GDP in the second quarter, and that more or less is what we got, with certain sectors, particularly accommodation and food, hit very badly. And we know in the travel sector, overseas travel, I mean, incredibly, passenger numbers through the terminals in April were 99% of prior year levels. That's the kind of setback that most any business would struggle with. So what we saw then, what we expected to see is a sort of recovery by halves, by quarter. That doesn't sound too Irish, but we thought that the economy would be recovering in Q3. We saw a 15% growth Q on Q. That's a 10% drop compared to prior year. So we're looking at this sort of 20% drop in Q2, 10% drop in Q3, and a 5% drop in the final quarter of the year. And for the year as a whole, that would mean output would be down by 10%. So that was the pattern of output we were expecting. The second shutdown, a bit of a setback, especially accommodation and food, but overall, it won't change the pattern of output, GDP output this year. And then secondly, from an unemployment perspective, we were expecting, once the furlough scheme ended at the end of October, that there'd be a surge in unemployment. We've already seen it increase to 1.6 million, or 4.8%, big level of redundancies in the last 3 months. But unemployment was going to soar to around 3 million, or 3 million plus. But we're all calling for, and now we've got this extension of the furlough scheme till March next year. And that means that the peak, the Bank of England, for example, expect the peak to be pushed back to the end of Q1 2021. So with a bit of luck, it should peak at a much lower level, maybe around 2.5 million. A lot of it in the, unfortunately, in the food and accommodation sector.
So you're of the view that that the delay will ease things rather than just push back the timing? in terms of?
Well, hopefully it'll be two things really. I think it depends, because the extension of the furlough scheme was a bit late in the day. It's a bit of a late call, but and a lot of plans were already in place. So it may well be that, with the possibility of, as we get into the beginning of next year, then things will look a lot different for businesses. And what we expect is, growth next year could be quite good, even if this level of recovery we expect is maintained. By the time you get into Q2, you're up against such poor figures. So most analysts now expect growth next year to be about 6%. It could be higher, it could be 10%. And indeed, Q2 is going to look fantastic. So I think there'll be a lot of energy around as we move into next year, a lot of positivity with spring coming, Easter on the way, vaccine possible as well. So attitudes will look a lot better, and things will be a lot better, hopefully, by the time we move into the new year. So we'll see this increase in unemployment, but maybe it'll be extended, as we're saying, till Q2 next year, and also it won't be as high as previously expected. And then the third element we always talk about is debt, because everybody's worried about the level of debt. We could be seeing currently the central government liability is 2.5 trillion, believe it or not. But the good news is the Bank of England's buying up all the pretense of QE is gone. Within this era of dire straits economics, I call it, it's money for nothing, gilts for free. The Treasury has the problem. The Debt Management Office issue the debt. The Bank of England scoops up the debt, and then it pays back the dividends. It's not just low interest rates, it's zero interest rates, because the bank has to pay back the coupons on the gilts. The great news is as well that this liability of the Treasury is an asset owned by the Bank of England, and both the Treasury and the Bank of England are owned by government. So at some stage in the future, the debt, like old soldiers, will just fade away. It'll just cease to be rolled over, and it will disappear from the balance sheet of the UK. No need to worry about the debt for our children, our grandchildren, our super great grandchildren. It will just magically disappear. So we call it money for nothing, gilts for free. Dire straits economics.
Well, I suppose you could go one step further and say walling it together should be rebranded as Brothers in Arms. But I suppose what businesses in 2020, the only certainty they've had is uncertainty. How do they begin to forecast for what lies ahead in the year to come?
Well, I think the focus has had to be on very much on cash and survival, and looking around at the people in the room, or the people in the lifeboat, the people in your business, and just wondering how many can you pull through this current crisis. But the important thing to remember is it is a short-term crisis in the long-term game, and this will be my fourth or fifth recession. But it's all about now scenario planning. You can't have a single pinpoint forecast of what's going to happen in your particular industry in any way, shape, or form. You've got to look at different scenarios. Will the recovery take place along with my central scenario we're talking about here? Will the vaccine improve things over much? But you've got to look at a series of scenarios, and at the same time look at some of the basics at the moment. So this time last year I was in Moscow talking about the threat of digital disruption. Now the game mode is all about digital acceleration. If you're not digital, if you're not online, if you're not sort of got your digital plans in hand at the moment, then you've got a real problem. So you've got a scenario plan, and you've got to get your digital scenario in place if you've not already done so.
That's great. Well, for now, thank you very much, John, and we'll look forward to talking to you in a little bit as well. Thank you. Our second speaker for this morning is Chris Yates. Now, Chris is a very experienced turnaround chief exec with a great track record of success. So he's worked on behalf of Endless Business Growth Fund, Hilco, on companies including Kiddicare, Modrin Pele, bringing Staples UK out of the American business. And to show how timely he is to our topic, particularly with an eye on the acquiring part of the headline, he's right in the middle of a big deal for his current company, FFX Tools, which is seeing some extraordinary growth numbers at the moment. So Chris is unable to join us live, but I caught up with him a little earlier. And I started off by asking Chris, having led a number of turnarounds, when you're brought in, where do you start?
So firstly, you have got to get great clarity from the stakeholders. What is the desired outcome? And really start from that perspective. So you go in And before you've even gone in, you find out from the stakeholders, what is your desired outcome? Do you want to fix it? Do you want to have a clean exit? Do you want to grow it? Do you want to fix it? Do you want to close it down? What do you want to do? And it's not just the bank or the investors, it'll also be the minority and stakeholders as well. So you've actually got alignment, so you actually know what they all want. Because if you don't know what we all want, you don't know where to start. So it's ironic, really. So you take the time. So it's basically time. So some companies say, well, we've got, I take the kiddie care example, right? So the guy spoke to me, I said, well, look, we're going to do something. We've got this opportunity. What do you think? Well, my first question back to the gang there is, well, what do you want? Well, what we want, and then you understand. That's the first stage. The second stage is when your first day in the business, it's like your first day on stage, because everybody's going to be looking at you, and you've got to be very, very cognizant of actually, if you say something, however small, people will run 1,000 miles. If you ask for the right things and very simple things, people will start to feel confident, because actually the most important thing, let's just say let's take the example that the stakeholders and everybody else think this is a fantastic business. It's just gone into a dark alley and can't get out. It hasn't got the wherewithal of how to resolve it. So there's always a keen, people are always keen to please, all right? 99% of people come to work for a good job. So where you start is you've got your stakeholders, and then you've got your people. And the problems are usually easily understood, all right? However, you then got to realize that having stopped and listened and looked, you make sure that what you're asking for are simple things that are non-complicated, that are very short-term in desire. So today we would like to deliver. This isn't tomorrow we'd like to do. By Monday of next week, in 4 days' time, we need to be in a place that we've got A, B, and C complete. So it's very short-term targets. And actually what it often means in that respect is it gives people the confidence they're doing some worthwhile work. Because often what you find is you get into an environment where a lot of things have been asked of a lot of people, but none of it is really connected together in a logical sequence of events. The logical sequence of events is we find out what people's desired outcomes are, stakeholders. We find out from the investors, what's your desired outcomes? Tick. Right. What's our cash position? What's our creditor position? What's our debtor's position? And set short-term goals. And those can be up to the hour, to be honest. You can be saying to people, but within an hour, can you just come back to me with A and B? So it starts getting people into action mode. Because often they'll have been in a fog. And the fog's not self-imposed, it just sort of happens. This fog comes over a business where people are running around, theoretically trying to do all the right things, but not knowing really what to do. Yeah. And actually, and the scare, well, they're always usually scared as well. There's the fear. So in a fear environment, they just run harder and faster, but probably in the wrong directions. So that's what you just do.
And right? What makes the difference between ultimately a turnaround being successful and unsuccessful?
When an unsuccessful turnaround usually means that the stakeholders and the investors have not had clarity of what they wanted to achieve by when. So you go in to do something and actually it don't work. Success should always be measured in that a turnaround isn't always about ensuring there is a business on the other side. It could be that actually the business model doesn't work, and actually it's about successfully delivering the stakeholders and the investors' desired outcomes. Yeah. And sadly, sometimes that isn't always in what the people want, but as long as people understand what you need to do and why you're doing it, and you are honest, because that's the biggest side of it. If the leader, in this example, me, if you are economic with the truth, then people will quickly see through you, because they're looking to find out whether you're going to be able to do what they want to do. Yeah. And then then it's fail. It's calamitous, to be honest.
So in the successful examples, and when you start to get some momentum into the turnaround, how do you shift the mindset in a business from that sense of fear and crisis into one that is looking more positively and looking for opportunities and is operating more normally?
Normal's quite an interesting concept, really, because what you're actually trying to do is not have a business that's actually operating in the norm. You're actually trying to change it to operate in a different way. So that's the first one. So what I do is, having worked, it's quite a staged process. You've done your bit about where do you start, done your bit about what does success look like, and then what I'll be doing is building up a plan, and the plan will revolve around 3 or 4 key objectives. One about one objective will be the desired output of performance, right? Secondly, one will be desired output of have you got the right team members? The third output will be, are you delivering what the customer's needs are, long-term and short-term? And finally, the most important bit of it all, are you operating the processes internally that mean that what you're doing today is going to add value in a medium and long term? Now, medium could be 1 week and long term could be 3 months. It doesn't really matter. So when you're talking about how do you then get to move from crisis through to opportunity, the crisis is your day one, but you can't operate in crisis for the next 24 months because you have to move the business through a process that says, we've stopped, we've looked, we've listened, we understand what the stakeholders are doing, and then I will build a plan. So in the first 12 weeks, and we'll make an assumption here that we are thinking this business has got legs and we've got a future to it, I'll build a plan. In that plan, I'll probably consult it very widely, all the way up and down the business, constantly asking, what do you think? What would you differently? What would you do? How would you do it? And what would you change? So you're constantly asking team members at all levels of the business 3 simple questions. What do you like? What don't you like? What would you change? Now, you'll probably find out you'll get a consistent bit of feedback. And you fit that into people, process, and output, and the customer. And once you've done that, you can then come up with, say, 3 or 4 key objectives for the next time period, which could be 12 months or 6 months or 3 months. It doesn't really matter. With timelines and deliverables, the things that we're going to be doing that are going to start delivering change to the business performance. Once you've done that, you then present that to the stakeholders and all of the people again. And so this is what I think the plan is. Now, some people say some bits are wrong, some bits are right, but that's absolutely fine. You then come to a consensus about the plan. Now, when you've got that consensus, that starts at the building of momentum, because people are now starting to operate on things that are going to be delivered in 2 months, 3 months, 4 months, or 5 months' time. So, in other words, your timeframes start to move from the crisis here and now. I've got to get done by this afternoon, or I've got to get done by Monday afternoon, or I've got to get done by tomorrow. To things that we're now starting to build actions and outputs that are about broadening the time frame.
Great. And lots of great tips there from Chris, who's lots of experience at the very sharp end of turnarounds. Our next speaker is Frank Ofnagaru. Frank's a director with Quantuma, with more than 20 years experience of financial and operational restructuring on all sides of the deal, for lenders, for distressed and special situation funds, as well as for SMEs and big corporates all the way up to FTSE 100s. Frank, welcome. For you, what's the first step that businesses should be taking to address, the impact of COVID-19?
Morning, Alex, and thank you for your time. Morning, everyone. I would say, I think it's very clear that since the onset of the pandemic, I think it's fair to say that most businesses have been in survival mode. So I would imagine that most businesses have probably, the extent to which they've kept their head above water by clearly taking steps to cut costs where they can, focus on cash management, and obviously benefit from the government's largesse in terms of furlough and other support schemes. Having survived that initial wave, I would be saying most businesses now should start to really turn their attention towards evaluating where the business is. So what is the current position of the business? from a micro sense, but also from a macro sense in terms of what's happened to the sector within which the business operates. So I very much call it the evaluation stage. So i.e. businesses should be either, if they got the internal resource to undertake a strategic review, or get advisors on board to assist them to do that. It's really about understanding, is the business model currently viable in a post-COVID world? Okay, is are the products viable? Has there been a change in terms of the market, in terms of the consumers, how they like to purchase? I think John made the point about the transition to digital. I think it's fair to say that any slow adopters of the move to digital, COVID will have accelerated that in no small shape or form. I think very much businesses should now really be focusing on understanding whether their business is still fit for purpose. And that extends to the supply chain. Is the supply chain as robust as it once was? Are there any gaps that have been identified in the supply chain that need to be remedied? And again, echoing John's points, I think that strategic review needs to then be allied with a look at scenario planning as well. So what's the current position of the business? Is it still fit for purpose? Has its channels changed? Has the customer base changed? I think only by understanding that current position can the business then be best placed to understand what to do next in terms of options.
Yeah, and absolutely. And once they have reached that position and they've got a firm understanding of where they are and what their market looks like, what are the options they should look at next?
Yeah, good questions. I think ultimately, again, having understood or gained a clear sight as to where the business is going and what the prospects are. Again, I think it's really about, armed with that information, then undertaking a options analysis. And again, the impact of COVID has been so dramatic that I genuinely believe, all options should be on the table for businesses in terms of considering what to do next. Now, that can range from, going for an exit as market conditions start to improve post a vaccine. And, we've seen in our business, certainly with our clients, many instances where shareholders who were looking to exit prior to COVID, either of a certain age, might not have the appetite to spend another 3 or 4 years to build back equity value to where it was. So you're finding some of those shareholders are looking to exit or planning to exit as soon as market conditions allow it and improve. Other options may range from actually, shedding non-core businesses and actually, shedding non-core businesses and focusing on your core business as a risk management measure. Or alternatively, also adding capabilities. If you're a business that needs to add a digital online channel, for example, actually some strategic acquisitions. I know my colleague Ian Button will talk to this in more detail. Some strategic acquisitions to add capabilities may be the way forward. You could also have a scenario where businesses decide, but actually, if the company or the business model is no longer fit for purpose, but yes, it is solvent, perhaps an orderly solvent wind down of an operating business might suit the needs and desire of all stakeholders. Mm-hmm. And finally, if it comes to it, you might be looking at either an accelerated M&A strategy by way of an insolvency pre-pack, or just an insolvency. If the business has run its course, then that might be an option with directors if the finance in that position will obviously need to consider.
No, thank you, Frank. I think that's a good point to bring in your colleague Ian to talk particularly about the M&A aspects that are available. Ian is a managing director in Quantuma's corporate finance team, and also has more than 20 years experience in the field, particularly specialising in advising shareholders on M&A plans, sourcing funding, and planning those shareholder restructurings. Ian, thanks for joining us this morning. In terms of what Frank was talking about, in terms of those M&A and investment strategies, what areas do you expect businesses to focus on in the next 12 months or so?
Morning, Alex, and morning everyone who's joining us. I think fundamentally that's going to focus firstly, as Frank was sort of talking about there, around the state of your balance sheet. And very much the first step for most businesses at the moment as we've talked about, has been survival for a period. I think Chris referred to that as well. But this is about getting your head up now and thinking about restructuring that debt, ensuring that you've got enough headroom and cash funding for whatever the future might bring. And you know, it's difficult for businesses to plan, but plan you must. And you really need to try and put together some strategic thoughts around how you want the business to look in what the next normal will be, whatever that might look like, and whenever that might really kick in. So I'd expect businesses to be renegotiating debts, looking at their covenant testing and repayment profiles, understanding how they're going to repay things like any VAT deferrals or Sybil's loans, which will start being repaid in early 2021. And that might cause them to introduce new equity into the business, whether that's from you know, private sources or private equity, or whether that might be something slightly more creative in terms of merging with another entity, or bringing in new partners. And so I think what we will start to see, therefore, is as businesses get their balance sheets settled, they'll start to be thinking around the types of M&A that might cause them to bring about, whether that is almost a defensive type of M&A in terms of protecting themselves, or whether that's more of an offensive M&A where it's looking to cause some change.
Yeah, just yeah, give us a little bit more detail about those two different types, and I suppose the scenarios in which you would deploy those strategies.
Yeah, so I guess defensive M&A, I guess is things brought about through necessity as much as anything else. It's protecting.
If I could just jump in, we just had a question from the audience of what is M&A. So mergers and acquisitions. So you know, buying and selling the business. Sorry, Ian. So yeah, defensive and offensive.
Yeah, no, that's, you know, this thing that's kept me in a living for 20 years, sort of advising businesses on things to buy or sell or how to raise money. So defensive types, sort of that necessity, if you like. So things as Frank was talking about there around sort of salvaging value from your balance sheet, where, you know, perhaps you might dispose of a non-core business or an asset. You decide that you want to realize some capital from perhaps something that's not going to be part of your long-term future, and then try and utilize that funding elsewhere in your business, or just frankly sort of exiting a distressed business that's draining cash from your business at the moment. And so you'd be better off, you know, closing it or going through a process as Frank talked about, or selling it to a third party. Or you might look to safeguard the markets that you're in. So perhaps hunkering down a little bit against where you've got capital intensive needs in a particular part of your business, or perhaps you spread the risk by bringing in some co-investment or partnership to defray some of that risk for yourself. So defensive around necessity. Offensive, I guess, is more about choice, and these are the things that need the funds, because typically it's about where you see the growth coming in the future. So these are things about transforming your operations. So we've talked already about, you know, enhancing your digital capabilities, whether there's a need to diversify, or it might be for some businesses, they've had blue sky thinking in the past that has always been slightly out of reach, but now actually it might still be slightly out of reach, but it's absolutely imperative that perhaps you accelerate your route down that, you know, accelerate your path down that route, and sort of cause that strategic change through, I don't know, disruptive technology, or perhaps even just acquiring things that previously you never thought you could acquire, but now actually are perhaps a little bit cheaper because the frothiness of the M&A market has dissipated a little bit in the last 12 months.
Yeah, frothiness isn't a word that's featured much in 2020 so far, but well, thanks for that brief summary, Ian. We'll bring Frank and John back on and open it out into a discussion. So just a reminder, as a couple of you already have, if you do want to ask a question, just hit the Q&A button and type it in, and I will bring it in and put it to our panel. But if I could just start off, Ian, with what you were saying there about, you know, you need to get your head up for whatever the future might bring. Is that difference between a company that, I suppose, survives and thrives and one that doesn't is that ability to be very clear about the current position and think strategically.
Yeah, I mean, Chris talked a little bit there, didn't he, around the sorts of things that business owners and business managers need to be thinking about. It's very difficult to know that moment, I think, for businesses as to when to switch from survival to sort of a more opportunistic or thriving sort of mode, and much of that is often driven by their reaction to the market. The trouble is the market is very, very unpredictable at the moment, and I think business owners through this second wave, when I talk to them, are starting to say, well, there's no point waiting for something to happen. I've got to be the catalyst for change, whatever that might be, whether that is M&A, whether that is tilting my business in a certain way to try and drive it on in the future. So I think for businesses, they're having to take a view on where the future might lead them. But the most important thing is that you've got plenty of cash headroom where you can, whether that's because you've taken advantage of government-backed schemes, or whether it is because you've brought new funding into your business. And actually making sure that all the people, all the equity holders in your business are contributing in some way. I've never been busier really talking to business owners who perhaps are looking to do something different. Some are looking to exit, but some are looking to exit owners who perhaps have been passive shareholders for some time, and actually want to use that equity for a new investor to bring new capital and a new drive to take it forward. Because business owners, I think, know that the next couple of years is going to be hard yards, and they need to be best prepared to do that as they can.
Yeah, and it touched on things that Chris was talking about. We've got a question from Colin Wild, sort of on that point of when the objectives and interests of perhaps management and owners diverge, and perhaps it's one for you, Frank. Colin's asked, have you any tips on how to deal with things when the objectives of the stakeholders vary widely? So how do you cope with that sort of situation?
Yeah, good question. I think for me, I think it's been alluded to by Ian as well. I think it comes down to just having a grown-up conversation about value. Right, my starting point in those kind of scenarios always to understand. So what's the current value of the business, and actually where does value break? And if they still, provided the value, equity value hasn't been impaired to the extent to which only really the key stakeholders or the ones of an economic interest is the bank or the debt providers, if there's still value in the equity stack, I think ultimately it comes down to again, going back to what is the prospects of this business in terms of not only preserving value, but also going on to grow value in the end. And actually by having that conversation and almost putting the personality and emotions aside and bringing it back to the quite boring conversation of what's the value in the business now? What value do all of you ideally want to get to, and how's best to achieve that? So I tend to bring it down to the real boring topics as to what's the bricks and mortar of actually how you build value in this business and take it forward.
No, absolutely. And John, as somebody who's an advisor and consultant to a range of businesses, I suppose the theory of it works very well, but sometimes taking the emotion and ego out of boardrooms is very difficult. So how do business leadership teams work through those problems when perhaps different views start to get, a bit more kind of generate conflict in the boardroom?
I think it comes down to the fundamental analysis, really. You try and take, as you're saying, take the emotion out of the situation by analysing the facts and laying out the facts, and then looking at the possible outcomes for different sets of stakeholders. And in doing so, then you can maybe develop a timeline where you can get more mutuality in the objectives as the conflict, or you can analyse out the conflict. So sometimes, living in a boardroom, which I have done as chief exec and chairman, sometimes as chief exec you can feel like a hostage situation where you're subject to pushes and pulls from different factions, even within the boardroom, offer in different stakeholder groups as well. And really you've got to sort of try and work out the emotion by coming down to analysis. And in most business situations, it's got to be analysis, 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 and then more analysis. So it can be tough, it can be difficult, but you've got to just lay out the scenarios and try and settle it out through tough negotiation.
Yeah,
I think, well, just picking up on that, I think one of the points I would say is it comes down to people's own personal analysis of risk, and you know, in a normal operating market, that those risk factors are perhaps a bit more sort of concertinaed up, and that there are narrower bands of risk. I think what we're seeing at the moment is a real huge spectrum of people on that risk sort of register, from people who are, you know, prepared to take a chance, you know, the offensive M&A providers, people who are investing in their businesses and sort of thinking what this might mean for them in 5 years' time, and acquiring things, all the way back to people who, as Frank said, you know, perhaps have gone through the last 6 months and just thought, do you know what, that's been really hard. I think I'm reaching the end of my business career. It's time to exit. It's time to pass this business on to somebody new. And to realize what I can from it at this time. And so what I would say is echoing some of what John was saying there, but actually, you know, people's risk profile is really key in that, and people being honest with themselves really as to what they want to get out of the coming period, because like I say, there's hard yards ahead, and people have got to decide where they stand on that.
Yeah, and
Yeah,
you mentioned
I was going to say, actually, what you can see it in, you know, friends around who are just deciding they've had enough and just packing out, really, because you can't take away that element of the word fear, that actually running a business can be quite fearful, and you know, if your reputation is at stake, if your livelihood at stake, if your family are at stake, you've got kids at school, you're worried about how many people you can let go, how many people can continue, and you get to a stage of real fear that the thought of continuing like this becomes just too much, and you've got to find a way out, because it's tough running a business. So I always say, if you're really enjoying the business, then you've got to look around, because something's about to go wrong in many ways. But at the moment, this last year has been quite incredible, and I think, you know, it's a lot of it comes down to you have a good support group, good people you can talk to, and just comes down to the analysis, the options moving forward. So we analyze into about 20 basic sectors in the economy, and it's important to understand that each are going to move at a different pace through the recovery. So a lot of the losses in the retail sector, where, you know, 12% of the shops have not yet reopened after shutdown. The pubs, more pubs at risk. Leisure entertainment seriously at risk. Events management seriously at risk. So different sectors are moving at different paces, and some, like healthcare, PPE, they're enjoying really positive growth. So it comes down to fundamental analysis. You need to get lots of help with that analysis, I think.
Yeah, and Ian, just a question from David McIntyre, I think, bringing on a point you said earlier about, you know, perhaps looking to bring on new investment and seeing what the business can do. So David's asked, you know, how do you see the funding landscape next year for banks and other funders such as ABLs? You know, do you think that they'll have opportunities, or they'll be busy with opportunities, or will they be busy with problems? How do you see it?
I guess one thing I'd say is the sort of the speed that the pandemic came on meant that, you know, heading into a recession, businesses weren't drained of cash resources in the way that often you see going into a typical recession. And, you know, John talked about that, you know, the sudden drop, but then the sudden comeback. And it's that sudden drop really that everything just switched off overnight. So to some degree, businesses that were in, you know, decent shape prior to the pandemic, you know, hopefully had some cash resources there. They've had the opportunity to take advantage of government schemes which have shored up those balance sheets for them. So, and that's why we're not seeing sort of this huge acceleration in receiverships or administrations or huge amounts of distress. In some ways, it's deferred out and will only come about when we see how the repayment of some of this debt and how long lockdowns or restrictions on economic activity take part. So, you know, for banks that took part in the CBILS and the BIBL schemes, you know, this was an opportunity for lots of those providers to put money into businesses and protect the debts that they perhaps already had with those businesses through government schemes. And actually, we've seen with one or two providers particularly the sort of the crowdfunding or the peer-to-peer lenders. It's been a huge opportunity for them to actually make a breakthrough into the market by putting their funding into these businesses, which gives them a foothold for future debt in going forward. Frank might be slightly better to talk about what he's seeing in terms of the distress side of it, but I think in the interim, what we've seen is a delay in that distress by the funding that's been made available through government schemes.
I think, all right, Alex, yeah, I think that is right. I think certainly I think it's fair to say there is a pause, and when I speak to lenders, including the asset-based lenders in the market generally, I think there's not a lot of deals being written at the moment because, to Ian's point, we have a strange phenomenon of you have almost profit poor businesses but who are yet cash rich, which is almost quite a contradiction in terms. So because of that, I think the real need isn't there yet. I think it's fair to say perhaps Q1, Q2, when the government support tabs get switched off, I think it's fair to say a lot of asset-based lenders will probably see it as an opportunity to grow market share. I think the reality is there will be some good businesses that will need working capital support, especially if their given sector recovers quite quickly. But I think at the same time, I think these alternative lenders will be exercising some caution as well, because clearly there's a lot of leveraged businesses there. So I think they'll be quite judicious in terms of what they take on. But there's certainly, a war chest and lots of appetite in the alternative lender space to write deals when the need arises. In terms of the response of the commercial lenders, I mean, that would be quite interesting, actually. I think, again, it's fair to say that those lenders have been more risk averse anyway, even pre-pandemic. Now, in response to the coming tide of plenty of business failures, especially the government has switched off. Now, actually, whether those banks will have the bandwidth to look to support as many clients as they can through those issues, or just embark on selling parcels of debt as a path of least resistance, I think is due to be seen. But certainly, I think the uncertainty in the market does create lots of opportunity there, but it's also quite a lot of risk as well.
Yeah, and for those businesses that are feeling in fairly robust shape and are looking at opportunities, and John, I'll come to you. Katie's asked, if there's an appetite to diversify by growth of new services to existing customers, would it be wise to build the plans but wait to execute until things are more stable? Or is it, is the real opportunity when things appear unstable?
Well, it's a good question, because I think it depends on several things. What is the appetite for risk? What is the risk profile of the venture that we're talking about? What is the cash position of the business? And what is the payback horizon looking like for the plans in play? So again, it comes down to pretty basic steps of analysis to understand these factors and decide if it is time to go. But I mean, many businesses have really thrived in recession and setback, and the first movers can do well, but it's not often the first movers who really reap the benefits. So it is a question of analyzing very carefully the several factors in play before rushing into any decision. But I think that, yeah, there's nothing wrong with having a go, but as long as you're not betting the firm and you're not over egging the sort of balance in doing so, the risk balance. So it comes down to, again, plausible analysis and looking that sectors have got really good growth potential as we move into 2021 and beyond, really. So the big key is the fundamental of, again, you hammer the message of digital. You got to go cloud, you got to go virtual, you got to go digital, and looking carefully at re-examining your user experience and user journey in so many different ways, and looking at recurring revenue patterns. So yeah, it comes down to that analysis, good framework analysis, and then analyzing and assessing your own weight of risk. But I think it's fair to say we think we got a pretty good steer on what happened this year. And with only 3 months to go, then we get more confident. But equally, the outlook for 2021 is looking pretty positive. You look at what's happening in China, for example. They're bouncing back significantly with a big setback in Q1, but growth in prospect for the year over 2%. So there is life after COVID, and there will be life. And I think going back to the bank point of view, the central bankers have made it clear that in the US, the Fed's saying they'll see no rate rises for 3 years. The Bank of England will have to follow suit. There's so much liquidity around that's pushing up asset prices, both in equities and also alternative assets like gold and Bitcoin. The fundamental environment is going to be so strong from a cash and liquidity point of view, and there will be a recovery. So yeah, if you've got the appetite and you've done your risk analysis, then go if the plans look great.
Frank, you had a wry smile when the question was asked about should people wait till it's more stable. Yeah, how do you view things?
Yeah, I think I probably echo John's views actually, and I guess that the right smile was, I think there is a lot of, well, there is a lot of the reality is a lot of good businesses will come on the block, at relatively, cheaper prices than they have been, because, you'll have lots of businesses that are viable, in terms of the business model and the customer channels, et cetera, but they just have an impaired balance sheet. And actually in that scenario, that presents a great opportunity for, other distressed investors, to actually pick up some bargains. And it's quite interesting as well. We've been speaking to, a few, funders, investors, who wouldn't normally class themselves as, shopping in distress or distressed space. But again, because of this realization that you have businesses which will be ordinarily viable and be nowhere near class as distressed or stressed, but because of COVID have taken a hit to their balance sheets. So you're actually finding non-distressed investors actually dropping down into the murky waters, if you excuse the expression, to actually look out for bargains. So I think there will be plenty of opportunities. I will caution though, especially in terms of management teams or certainly people looking at buying businesses, is really understanding the working capital requirements as a business comes into the recovery phase. I think is going to be absolutely critical. Understanding the pace at which the debt that's been loaded on the balance sheet can either be retired or unwound, and allay that with actually modeling in an uncertain environment forecast demand and the working capital associated with that forecast demand is going to be absolutely critical. And from experience, many businesses fail actually not due to not making money, but actually just running out of cash because they don't understand their working capital needs. So that's will be critically important that people really get a handle of that.
No, absolutely. And you mentioned about distressed balance sheets in a perhaps more mundane, sort of bureaucratic sense. Ian, we've got a question come in around accounts, and essentially asking, how do you get a set of accounts signed off these days without a going concern qualification, and what impact this gentleman is talking about his credit rating being hit badly due to late filing, but fundamentally still having a sound business. So how do FDs and business owners get around or address that problem?
Yeah, well, I'm not an auditor, although I was in my earlier years of my career. But there's quite a pertinent point. I mean, I'm working currently with a fairly large business who has a Big Four auditor, who have had, frankly, enormous challenges in being able to get out to businesses and do their audits for this year. And, because of social distancing, not actually able to go and visit businesses in a way, they lost, 3 or 4 months of their season of work. So I sympathise with the point on the late filing, and I think that will only be worse for next year because lots of audit firms will end up prioritising certain clients, particularly listed clients, who they will have to do first, and therefore it will be private companies who perhaps might suffer a little bit in terms of that timing. In terms of going concern, an auditor will always look at the forecasts and free cash that the business thinks it has available to fund itself for the next 12 months. That's essentially the definition of going concern. So back to the points that have previously been made about whilst it is very difficult to forecast and plan anything, plan you must, and you need to have a series of scenarios, whether that is things come back to normal in the early part of 2021 for your business, or whether there will be a longer, more drawn out process if you're perhaps in hospitality or those sorts of areas. or whether there is a fear that there might be, heaven forbid, a third wave that might come through before there is a vaccine program that's in place, and therefore we go back around the same loop that we're going around at the moment. So, flexibility on planning, taking advice, and and presenting a series of scenarios is perhaps the only thing I could hopefully say.
Yeah. Frank, you mentioned earlier in your piece around government largesse, and Paul Kelly's followed up on that. He's asked, have too many bad businesses been saved at the expense of investment in more sustainable businesses?
Yeah, I mean, it's a really good question, and I guess it's one that's difficult to give a black and white answer, I guess. I think, look, instinctively, I think a lot of us, do indeed know and have the sense that there are some, how shall I put it, zombie companies out there. And what I mean by that is actually companies that are in effect, insolvent, unable to pay their debts as and when they fall due, if it wasn't for the government support. Now, I think the reality is, I think, I will say with some humility, any business failure is always a tragedy, because ultimately people are losing their livelihoods. So any business failure is a tragedy. But I also do have sympathy for those that take the view, but actually at some point, the government almost does need to allow, some businesses that are no longer viable to fail, because ultimately to allow that recycling of resources to more viable businesses. But like I said, I hate to give a yes and no answer because every business failure is a tragedy, but I also do have sympathy with those that said, look, at some point, businesses, need to be freed up of resources that could be put to use to more viable businesses. I do have sympathy for that view, definitely.
Yeah, John, as a perhaps more independent voice, can you give a yes or no answer to that question?
Yeah, I don't think it's a question of a finite resource which has to be supremely allocated between good and bad businesses. This is like, sometimes you hear this stuff coming out of the Bank of England, but there's lots of resource there. But at the end of the day, businesses can't outrun their markets. So there may be a short-term fix, but at the end of the day, the market will decide what is a viable business. And I think, the market will let the market run, and the market will decide if there is a future for any particular business in that particular sector. And there's always the great word pivot. We hear about pivot. There's really challenging which way you're moving and the opportunity to pivot. But this idea that there's a finite capital which has to be supremely allocated between good and bad businesses, not for me. I think, you can't run the market, and the market will decide if you've got a living or not.
Yeah. Frank, if I could put the next question to you from somebody who doesn't want to give their name, but in a scenario where there appears to be a 30 to 40% drop in business, how do you approach right-sizing that business?
Yeah, it's another great question, and again, I think it's you can't look at that exercise about in isolation. That thing's about understanding, well, what does that drop in business mean to your profitability? Actually, the 40%, I'd imagine for most businesses, a 40% drop in business, actually you're in loss-making territory. So I guess that the first step is really doing a bit of analysis to understand how much cost can you shed to get you at least close to break even without fundamentally damaging that business and the business's ability to operate efficiently. I guess it's probably the first thing you'd have to look at as a board to understand, yes, we can trim costs, but actually trimming costs with one eye on the current level of demand, not just now, but to come as well. Because another point to make it, actually, if you're trimming costs now, when the recovery comes, actually, how quickly and at what cost will it need for you to then ramp back up again to take advantage of that recovery? So it's a very difficult piece. But I think as a sense check, it's really about understanding how much cost can we trim now to get to as close a break-even point as possible to allow us to then keep our head above water sustainably until the recovery comes. I think that's got to be the necessary bit of analysis that you do. And actually, if the answer to that is, well, 40% drop is we just can't get there, then directors do need to be asking themselves, actually, to protect ourselves and the company's creditors, do we need to be exploring other options, either going down the formal route or going down an accelerated M&A route, or perhaps trying to look for a strategic investor, to try and bridge that gap, to buy you some time to then take advantage of recovery. So I really, again, it comes down to, I like John's expression today of cold hard analysis, really understanding what the numbers look like, but also keeping one eye on the wider sector piece as well. Actually, if you're able to get your costs down close to break even, and you're able to find a source of finance to keep your head above water, have you still got a market there fundamentally? So actually, is the sector still viable? Because if it isn't, then actually trying to get down to break even is almost a waste of time. So I think there's a two-pronged analytical look to it. The micro bit in terms of how can you get close to break even and survive, but also the wider market piece as well. Is there still a market there that makes your business viable?
Great. We're nearly out of time, so I'll ask the same question to each of you in turn. What are you optimistic about for 2021? And if I could come to you first, Ian.
Oh, crikey. I presume you're talking just about the world of business rather than football or anything more general than that. But I think I'm probably optimistic that in the world of M&A there is plenty of activity. Yes, there are areas of distress and difficulty, but actually I think what we're seeing is businesses being adaptable, and changing some of their processes, perhaps shedding some approaches that perhaps they would have shed over a longer period, but have been forced to do it more quickly. And so I think I'm optimistic that actually we will see businesses emerge stronger as a result of this. They might have more debt on the balance sheet than they would like, and that might cause them to have to do some replanning or bringing in new equity. But I think in terms of their operations, their focus on the market, those businesses that are able to survive, I think will be stronger as a result.
Great. John.
Well, I have I have a contrarian bias where I'm brought up to challenge, and I have an optimism bias where I always try and find out the best scenario. The fact is that this too will pass, this crisis. As we move into 2021, then we'll see a reasonably strong recovery in the economy compared to the current year. And for any business, it goes back, the fundamentals of analysis still play. You're looking at a safe structure, look at your structure and framework, and you look at the system, strategy and staff, and you do your market analysis. And you always do what I call CBS news. You look at your competitors, you look at your buyers, you look at your suppliers, CBS, and you look at the news, the opportunities for new players or the threats from new players and new products and new platforms. So the fundamentals come into play in a positively forward-looking economy with an incredibly accommodating monetary structure with low rates set for some time into the future.
And Frank.
So at the risk of sounding fluffier than John and Ian, I guess for me, from probably a more looking forward to an increasingly more open business culture. Look, the UK business is not a monolith, clearly, but certainly what I think I have seen from the pandemic has been, because the impact has been so sudden and catastrophic in many senses, actually you'll find that quite a lot of C-suite executives have actually been more open than they otherwise would be. So the amount of kind of coaching conversations I've had with some quite senior clients, just in terms of them opening up about their fears, worries, not just about their business, but personally as well, I think it's made for a lot more productive conversation than soul searching by lots of UK businesses, actually. So I'm looking forward to really, whether that culture sustains, I don't quite know, but I'm looking forward to perhaps having a bit more of an open business culture in the UK.
Fingers crossed it is sustained. Unfortunately, that's all we've got time for this morning. So I'd like to thank Ian, John and Frank and Chris for their great contributions this morning. I hope you've all found it to be of interest. I know we've had quite a few comments come through in the last few minutes to that effect. So really pleased that you found it to be really useful. We will be sharing the full recording online, as well as having a write-up on the business desk in the next few days. So do keep your eyes out for that. But thank you very much for joining us this morning, and hope you have a great day. Thank you.
Thank you.